The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bounce back in U.S. manufacturing leads to a rebound in U.S. equities. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. You take a look at the S&P 500 heading for a record high, higher by about 0.5% right now. We did have U.S. ISM manufacturing come in strong this morning, giving a lift to the equity market. You can see that in the NASDAQ 100 as well, giving a lift to yields. The 10-year Treasury yield currently higher by about 4 basis points. We are knocking on the door of 430. And then you take a look at the dollar, also continuing to rally here. The Bloomberg Dollar Spot Index higher by about 0.3%, Romaine.
Yeah, the big moves today tied to the big move in economic data, the U.S. manufacturing activity, which had fallen into contraction all the way back in 2022 and struggled to bounce back since. Well, it unexpectedly expanded in January, both order backlogs and export orders rising. Now, the grain of salt there is that business inventories, they did contract to their lowest since 2022. And remember, January, historically a reorder month for a lot of companies coming out of the holiday shopping season. Still, the ISM manufacturing data is a fundamentally positive story for equity investors looking for any data to support elevated valuations. The news sent stocks higher, also pushed up Treasury yields. Traders pairing bets now on Fed interest rate cuts, and now starting to whisper just again here about a potential Goldilocks narrative of solid growth with contained inflation. Of course, risks, they still abound, at least the uncertainty does, when it comes to a potentially reshaped Fed and the potential impact on markets. That dollar rally, it's extending for a second day, and that near unprecedented sell-off in gold extending for a third. Trump pushing Kevin Warsh to succeed Jay Powell as Fed chair. Morgan Stanley strategists say expect continued volatility, particularly in bond markets, as a Warsh-led Fed may be, well, a bit more opaque in its public communications than it was for past Fed chairs.
Let's talk a little bit more about Kevin Warsh, because in addition to his distaste for forward guidance coming from the Fed, he also doesn't love a big balance sheet. We know that he's been a critic of QE. So I thought it'd be interesting to take a look at the Fed's balance sheet. It stands at $6.6 trillion right now. You can see that that's actually down from $9 trillion. We reached that after the pandemic. And for context, take a look at where we stood when Warsh was actually Fed governor. That was from 2006 to 2011. We can see when QE started and when the balance sheet started to expand. Of course, that looks quaint compared to the levels that we're at right now. So as you said, Romaine, there's a lot of questions about what the future of the Fed looks like under Kevin Warsh, and specifically what the future of this line looks like as well. All
right, well, our next guest kicking us off to the close knows a lot about monetary policy. Former Reserve Bank of India governor, former IMF chief economist, and now professor at the Chicago Booth School. Raghuram Rajan joins us right now. And Professor, I do want to start off here with the general idea of what you think the Fed might actually be focused on. There's been so much talk about Warsh's past comments and where he may steer the Fed. I know we have the dual mandate, but there's the balance sheet. And of course, there's the interplay right now between the Fed and the Treasury. Where should we be looking?
Well, I think the first thing he needs to do is calm down tempers, reduce conflictual situations. He's going to back off from some of the public language that has been happening. Certainly, he's going to try and get the administration to keep its opinions to itself for a while giving him the chance to establish himself. So the first thing is create that separation once again. Second, I think important thing is to get his handle on monetary policy, his opinions starting to percolate into the Fed. Of course, he doesn't make monetary policy alone. It's a 12-member committee, so he has to start persuading people of his direction, and that will happen over time. It's not going to happen immediately. So I think those are the first tasks. Get confidence of his fellow staff members, his fellow FOMC members, but also create some separation from the administration.
There's also this idea about Fed communication, particularly in kind of this, I guess we'll just call it kind of the Bernanke era, the introduction of the press conferences at the Fed meetings, and the idea that there's this expectation in the markets that we should not only be hearing from the Fed chair, we should be hearing from all of the Fed members and governors on a relatively routine basis. But is there sort of an idea here that maybe that should be rethought? Is maybe sort of too much communication not necessarily a good thing?
That's a good point. I mean, it could play both ways. What the press conference does is gives the Fed chair a way to imprint his views on interpretation, because yes, the decision is out there, the market reacts, and then he's trying to give you a sense of how to think about it. That can backfire sometimes. And as you said, when there are many members of the FOMC talking, it does create a little bit of noise. Now, noise is potentially sometimes healthy, so that you know there's not just one opinion, but sometimes it can be quite distracting. So I think this is a good issue for the Fed to debate. Remember, it was Powell who did a press conference after every policy decision. It can be rolled back. I don't know what Kevin Warsh's view on this is, but it is something that could be debated by the Fed.
It's a good point that it was Jerome Powell who did put in place that press conference at every meeting. I do wonder if he kind of regrets that now. But even outside of the press conference that we get after Fed decisions, I mean, Neil Dutta of Renaissance Macro points out that even during Kevin Warsh's time as a Fed governor, he never really gave speeches on his views on the economic and policy outlook, which is certainly a departure from sort of the system that we have right now. So I'm wondering, what you think the future of that is. If you do have a Fed chair that is reticent to really talk in public too much, do you think that, we see less public statements from the Fed governors and from the regional bank presidents?
No, I think it does open up space for some of the Fed governors and some of the regional Fed presidents to have more of their opinion out there. I do think that the Fed chair has a number of occasions where he has to speak, and he will offer his comments then. He may not do every press conference after every meeting, but there'll be plenty of opportunities for you to know and understand Mr. Warsh's views. And so I don't think it's entirely a bad thing if they step back. At the same time, I don't think it's entirely necessary either.
All right, yeah, we shouldn't expect his views to be a secret necessarily. Let's talk a little bit about the balance sheet, where we're taking a look at it in context to where it has been, currently standing at about $6.6 trillion. We know it has touched $9 trillion in the past few years. It's no secret that Kevin Warsh is not a fan of QE, and I wonder what you think the future of the balance sheet could look like under his chairmanship, especially when you consider in that, as you pointed out, he's just one of 12 votes.
Yeah, I think this is a battle he will probably fight later rather than earlier. I think the early issue is more how to get consensus on the rate-setting process. The balance sheet comes down the line. What we've seen already is that the Fed, after shrinking the balance sheet some, has believed pause is probably the right thing right now, which leads to the question if 6.6 trillion is what it is in normal times, what does it get to be in abnormal times when you really need to expand the balance sheet again? So good times is when you try and shrink the balance sheet, you try and get monetary policy back to even keel. One of the big concerns for central banks around the world, you've seen it with the Bank of Japan, is when the central bank is holding a ton of government securities. Right now, I think for the Fed, it's about $4.5 trillion. It does lead to the question, at what point does the central bank look like it's funding the government? And if it's also expanding its balance sheet at a time that the government needs a lot of funding, are we back to the old story of the Federal Reserve or the central bank funding the government? So this is something that central bank governors have to tackle, because in the guise of providing ample reserves to the system, they're also holding a lot of government securities at a time that government financing is becoming more difficult. So this is a question that many of them will have to ask.
All right, Professor, always a pleasure. Raghuram Rajan, former IMF chief economist, professor over at the University of Chicago Booth School of Business. As we continue our coverage here on this Monday afternoon, a closer look at Federal Reserve policy, a closer look at the U.S. economy, and tying it all together into the credit markets. Atsi Sheth going to be joining us in just a second over at Moody's Ratings.
Then we'll turn to the other big story behind the day's market action, the moves in metals. Mitchell Krebs, he is the chairman and CEO over at Coeur Mining, discusses what he's seeing from the mines themselves.
And we're going to go from metals to, how about this for a pivot? Super Bowl advertising. Gary Vaynerchuk going to be joining us in just a bit later in the program to talk about his latest Super Bowl ad and what to expect for the big spend come this Sunday. Stick with us. This is The Close on Bloomberg.
Well, stocks seizing today on a new tailwind, the biggest jump in U.S. manufacturing activity since 2022. But the U.S. economy is not out of the woods yet, with our next guest expecting slightly lower GDP growth this year than in 2025. Joining us live, I'm pleased to say, it's Atsi Sheth. She is Chief Credit Officer over at Moody's Ratings. Great to see you in person. So it's interesting, right? Because as I said, slightly lower GDP growth, but you combine that with what we saw in ISM manufacturing today, the fact that we are still expecting growth in 2026. I mean, the economy is still chugging along here and then some.
I'd say better than chugging along even. It's been remarkably resilient. And if you look back and think about, Liberation Day and what people expected then to now, you actually have this jump in manufacturing. So I would say better than chugging along.
Better than chugging along. Let's talk about what this means for Kevin Warsh, for example. I won't ask you directly about him, but you think about the economy that he's potentially inheriting when he potentially takes over as Fed chair in mid-May. I mean, we're at the point where, as we talked about, I mean, the economy looks good. There are some concerns, or there's the risk out there that inflation could stay where it is or maybe even reignite a little bit. What does that mean in terms of the outlook for how much the Fed can actually lower interest rates here?
Yeah, that job is always a difficult one. So I shouldn't say that one year is more difficult than another. But if you look at the challenges ahead for the Federal Reserve this year, on the one hand, economic growth really solid in terms of output. On the other hand, the jobs market is cooling. So you haven't seen job creation. You've seen job creation slow down, and particularly in sectors outside healthcare and some service sectors, it is slowing down. So that's sort of the offset of the very good output data. Then you have inflation, which is cooling. It's not yet back to the Fed's target, but it's cooling from very high levels. So you've had now a few years of inflation being high, and that has led to affordability concerns on the part of the consumer. So you want to keep inflation in check, but high rates actually add to the affordability consumer for the concerns for the consumer, because that means cost of borrowing, your credit card debt, your mortgage debt, all of that is higher. This is a very difficult environment to be in. But that's why we have experts making those policy decisions.
Well, I am curious, though, too. We've been talking a lot today about kind of how AI kind of intersects with all this. You talk about an economy doing better than chugging along. Obviously, AI and the spend on that has been a big boon, certainly to overall aggregate GDP numbers. Of course, with that, there's been a lot of concerns about that stoking inflation, whether it's, the price that people pay for power, even water, things like that. And then there's the debt angle into it. You have corporate borrowers, at least based on Bloomberg reporting, that are expected to come to the market this year, really over the next couple of months, in what could be an unprecedented wave of borrowing, primarily for AI. Is that going to be a tailwind or a headwind?
Both. It is a tailwind today because what's happened over the last year is AI has created demand in the economy, and maybe some of this manufacturing demand even comes from the capex that has been imbued into the economy. Two, there has been debt demand, but at a time where the financing environment was actually quite salubrious, so the debt has been added. Three, it is expected, and this is a big expectation, that AI will add to productivity in the economy, and that is something that can goose the economy, but we're yet to see that. So that's sort of on the tailwind side. On the headwind side, you talked about debt, and the debt is actually quite chunky. So it's not, a few million here and there that are being issued. It's in the billions. And if that productivity and profitability payoff does not occur, then that debt is an issue. One thing I will say, because people compare this to sort of, the internet and the dot-com bubbles, the borrowers now tend to be the large hyperscalers who are very cash rich and not highly leveraged. So they're starting off at a better point than, say, small startups were in the late 1990s.
I mean, one concern that's been raised, particularly about borrowing to fund these data centers, is that you're basically using that money, leverage, to basically buy into something that could actually not have the same lifespan as the debt itself. The idea that these data centers, they're great, they're shiny, but we know 2 years from now, somebody will just, Jensen Huang will decide you need a much different chip or a much different type of data center operation. Is that a material risk that you're looking at right now with regards to credit quality?
Absolutely.
Yeah.
So the risk of your lease renewal, so either your lease is not renewed or renewed at a much lower rate, the risk of obsolescence of the data center itself, and these are absolutely considerations we as a rating agency take into account. These are also considerations I should say that those who are investing in are also aware of and are probably controlling for as well. But it is definitely a salient risk.
All right. Atsi, I have to leave it there. Always a pleasure speaking to you. Atsi Sheth is Chief Credit Officer over at Moody's. All right, when we come back, we're going to take a closer look into those earnings that we got out of Disney and, more importantly, try to answer some questions here about Bob Iger's reign and who his successor might be. That's coming up next here on The Close. This is Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And we start off today with Palantir. William Blair upgrading to outperform. This ahead of the data analysis company's earnings after the bell today. The upgrade is based on the Trump administration continuing to go all in on using Palantir's services and based on a 30% pullback in the stock since its record high in November. Those shares rising for the first day in 6. Next up, Best Buy. JP Morgan downgrading the electronics retailer to neutral and cutting its once street high price target of $99 to a near street low 76. The analysts forecasting a tough fiscal Q4 earnings report next month, given slower computer sales. Nevertheless, those shares rising for the first day in 7. Finally, McDonald's, BTIG upgrading to buy on an improving financial picture for lower-income consumers. Those shares rising for the 7th day in the past 10, right now at its highest levels so far of 2026. Those are some of our top calls. We do want to switch from Mickey D's to, well, Mickey Mouse. Disney's first quarter results driven largely by the strength of its parks and cruise business. There's still some concerns about the forecast it gave that some people see as just a little bit soft. That unit, though, at the parks business, that's going to be key because a lot of folks speculating that the replacement for CEO Bob Iger could be the head of that division, Josh D'Amaro. Joining us right now to talk a bit about this is David Joyce, Senior Analyst over at Seaport Research Partners. All right, let's start with the quarter that was and with that operating income forecast. There seemed to be a reason why you saw the shares down here on the day, David. What did you make, first of all, of the quarter that just passed?
On the whole, it was as expected, but with a little bit better performance from the segment income margins at the parks and from the direct-to-consumer SVOD portion of the entertainment sector. Where there was some softness was due to the marketing expenses because they had 9 new films, including Zootopia and Avatar, that hit the earnings in the December quarter. But those revenue benefits from the very strong theatrical release will be helping in the current quarter and going forward. So it was basically an as-expected quarter, and they reiterated their guidance for the year. But they had been telegraphing that this is going to be a back half-weighted growth year, and I think you're seeing some of the pressure right now coming from some of the same data points from the company that suggest that this next quarter is still going to have some pressures before you see that back half growth.
So with regards to the media and entertainment side of this, I mean, I understand that, okay, obviously putting out all those new movies has a cost to it. We also saw a lot of weakness in the sports division, largely because of the cost of new contracts. Is that idea that these are kind of one-offs and that basically they make up for that down the road later in the year with whatever revenue is generated from those businesses?
Yes, on the theatrical release side, you had Zootopia do better than expected globally. Avatar maybe a little softer than expected, but those are franchises that help with, theme park visitation and further, ways to monetize those franchises. The sports pressure was on some new WWE and NBA expenses that will continue to weigh on the margins over the course of this year. So it wasn't one-off particularly, but it will be lapping a year from now. But what comes with those higher programming expenses for the sports is pretty immediate benefit from higher advertising because viewership continues to be very strong for sports properties, and then over time they'll likely be able to get some more increases on their carriage fees for those networks and for the direct-to-consumer streaming side in subscription price increases to reflect that increased investment.
And David, I'm just curious to hear your thoughts on the share reaction today, because you take a look at Disney shares down about 6.7% at the moment. At their worst moment, they were down about 8%. So you could say that the outlook was tepid. Some of the sore points in the report, though, to your point, were pretty much well telegraphed. I mean, what do you make of why this stock is being sold off so hard?
Yeah, in the short term, it's just a focus on the immediate quarter, having some pressures from these extra sports rights. But it still feeds into the notion that when you get into the back half of the year, they will have some better benefit from higher advertising revenue as they get into the postseason for some of the sports rights. And then on the theme parks as well, there's some early expenses before they launch this next cruise ship. And that should add 120 million per quarter or so of revenue, which is going to be like an ongoing benefit. So again, there's some investments in the short term. There's some investments in the theme park for a new Frozen World in Disneyland Paris, for example. But I think that with the full year guide not changing, I think that gives me comfort in suggesting that I would be buying this pullback. I think they'll still grow EPS by at least 10% this year. Not terribly exciting when we're talking about some other companies in the media space, in the streaming space that can be doing mid-teens growth, perhaps. But this has a very diversified, strong set of well-recognized brands. So I think the comfort level should still be there long term.
All right, David, great to get some time with you. That is David Joyce. He is senior analyst over at Seaport Research Partners. And of course, Romaine, the earnings today, only one part of the Disney story. We're going to be watching this stock very closely all week as we await potential succession plans.
Yeah, they've said, or the reporting is that an announcement may come this week, or there's a board decision will come this week. Seems like all the speculation right now is about the head of the parks business, which, let's face it, has been the primary driver of growth for this company for quite some time. But I seem to remember the last CEO they selected was also head of the parks business, and he didn't last too long.
Yeah. So we'll see, of course, how this one shakes out. But, of course, this is one of the most
Have you gone to Disney World anytime?
Not since I was 7, which was a long time ago. Coming up, all that glitters must be gold. We're talking with Coeur Mining up next.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping an eye on these equity markets, also keeping an eye on these precious metals, Romaine.
You can't look away, Katie Greifeld. This is phenomenal. We'll tell our grandchildren about this one day.
Certainly.
I
already told my cat about it.
Okay, I want to hear what he had to say. But you talk about the parabolic moves that we saw higher, and now, of course, over the last few sessions, we've seen a parabolic move lower, and it's really raising the question as to what was actually even driving this rally that we saw in gold and silver.
It's also really interesting to pair what's going on with gold, with silver, with what's going on with the dollar. It's the reverse of the debasement trade that we spent a lot of January talking about. Now you're in a situation where gold and silver falling out of bed and the Bloomberg dollar coming back.
Absolutely. And of course, it's not just the metals themselves. Of course, the companies that mine the gold and silver, of course, took a ride higher and now taking a little bit of a move lower over the last 4 sessions. So let's bring in somebody who knows a lot more about what's going on than we do. Mitchell Krebs is the chairman and CEO over at Coeur Mining, which owns and operates silver and gold mining properties. Mitch, great to have you here on the program. I do want to start off with just sort of what actually drove this phenomenal move higher, particularly last year? I mean, we saw the price first of gold, and then it seemed like investors then latched on to silver. Was this being driven by speculators, or was this more the industrial side, central banks? Do you have any sense of exactly who was really buying this stuff?
Yeah. Well, thanks for having me again. Good to see you both. I think you hit on a list of all the above were driving these prices, and I think we'll continue to do so. That dollar debasement trade, central banks looking to diversify their holdings away from U.S. Treasuries has been a huge tailwind, in particular for gold over the last few years. The expectation of lower interest rates going forward, debt deficits, geopolitical instability. I mean, this is sort of like the list of every possible tailwind you could hope to have blowing all at the same time last year for gold. Silver's a little bit different. You have all of those same sort of macro themes pushing demand higher, but you also have a really hefty industrial demand component for silver. Think electrification, whether it's on the generation side, solar panels, distribution, anything with an on-off switch, circuits, semiconductors, silver's in those. And even on the end use side, whether it's electric vehicles, robotics, data centers, AI, silver benefits from all of those things. And at the same time, there's been 5 years in a row now of supply-demand deficits for silver. Silver's a much smaller market than gold, so you can see a lot more of this kind of speculation buildup in a smaller market like silver.
Well, this is what I'm curious about. And one reason why I asked you that question is about the sustainability of some of the elevated prices, even when you take the speculators out of the equation. Are we seeing a structural shift here in how people view these metals, whether it is the need, as you said, for a silver that goes into so many things, and we also forget defense as well, and gold, which maybe doesn't have the same industrial utility, but if people are worried about the debasement of the dollar, that this is now something that lasts for longer than just, a few months or a year?
I think we are. I think we're seeing a shift in monetary policy across the globe. It's certainly in my 30 years, I've never seen anything like it. So in the case of gold, I don't see any of these trends reversing themselves anytime soon. And in the case of silver, the same can be said. I think one of the things that really has changed is just the world is waking up to this awareness of how critical all of these commodities and minerals and metals are to everyday life, and not only from an economic security standpoint, national defense, security standpoint. The world is now finally realizing that these metals are critical, and I think that's something that I've never seen. We've been talking about a lot of these things for a lot of years, and finally now everybody around the world is realizing it.
Well, it's interesting, too, to think about the different sources of demand. You think about just investors potentially viewing these metals differently than they have in the past, but then you also have the central bank bid, Mitchell, and then you have, there was a really interesting story by Bloomberg News last week that you think about stablecoin issuer Tether is basically entered the market as a new central bank in terms of their demand. And, I'm curious, how you see those forces coming together. The fact that you do also have this bid from these central banks with, at the same time, some of these individual investors and maybe beyond that waking up, as you say.
Yeah. The Tether article was amazing. And they've quietly amassed a huge stockpile of gold that matches some of the largest central banks around the world. I think a lot of people have just sort of fallen behind behind this central bank buying that's been just there consistently now for years on end. Really started back in 2022 with the Russian invasion of Ukraine. Central banks decided they needed to accelerate that pace of diversifying away from the U.S. dollar, and a lot of these investors have followed that theme ever since, and it's something that we don't see changing anytime soon.
Well, I'm glad that you also saw that Tether article because I thought it was fascinating, and it made a lot of things make sense when you think about just this constant demand that we're seeing for gold, Tether being a small piece of that. But let's talk about what this means for miners and specifically for your business as well, because we got the new news last week that your shareholders approved an acquisition of New Gold. And you think about your industry right now, do you see more consolidation on the way, and do you see it specifically for Coeur mining?
Yeah, we have been reinvesting back in the business both through organic growth, things like exploration and expansions, and then we've done now 2 acquisitions back to back, one last year called Silvercrest, and now, as you mentioned, New Gold. And what we're creating here is a real North American mining powerhouse, one of the world's largest silver producing companies, one of the top 5 largest in the world, one of the top 10 largest precious metals mining companies, U.S. based, U.S. domiciled, North America only footprint. So as more and more investors are looking for exposure to metals and they're looking to the equities, jurisdiction is a real priority for them. They want low risk exposure, and that's what we offer, especially with these acquisitions, focusing just on Canada, the U.S. and Mexico. So we've done these 2 acquisitions now at really good times, you know, in hindsight, looking at where prices have come versus when we made those acquisitions. And I think we're going to continue to see more consolidation. There was just another transaction announced this morning in our sector. And I think as companies and even investors start to gain comfort that these price levels are sustainable, you'll see more transaction activity, and I think you'll see more investment capital come into the equities. For as far as these metals have come, these equities have not really reflected these higher prices yet. So that's what makes us so excited is, you know, only in the next few weeks will our industry, and including us, start reporting earnings just from the fourth quarter when prices were starting to be higher. Just wait, you know, for the next few quarters as we start to print some really large cash flow quarters based on these higher prices.
All right, Mitch, well, we got to get you back when that happens. Always a great conversation. Mitchell Krebs, the chairman, CEO over at silver and gold company Coeur Mining. When we come back, we're going to talk about AI, we're going to talk about data centers, and we're going to talk about debt. Oracle hoping to ride the AI high with a $25 billion bond sale, a bond sale that's just the start of more to come. It's our stock of the hour, and it's up next right here on The Close on Bloomberg.
Well, our stock of the hour today is Oracle. Shares now dipping into the red after the company announced a $25 billion sale of high-grade bonds in an effort to shore up AI funding. Joining us live is Bloomberg TV markets correspondent Norah Mulinda. Interesting share reaction here, pretty muted overall when you consider all the concerns about the debt that Oracle is taking on to fund its hopes and dreams here. What exactly is their plan with this specific bond sale?
Well, of course, when we're thinking about how they're raising money through debt, we're really thinking about the fact that they're not intending to really dilute shareholders. They're really trying to find a way to fund all of their efforts and ambitions on the future. But while you're really seeing a decline in shares today, what I'm hearing from my sources is that essentially people are concerned as to whether or not we're actually going to see a return to the magnitude that the company expects on the investors' investment, because of course there's been these broader fears in the big tech space as to whether or not these companies are potentially getting ahead of themselves, because we haven't really seen whether or not these returns are guaranteed, because that's something that we're going to need to take some more time to really spell out and see really actually happening in practice.
So, I mean, so Oracle's saying where? All this money is basically just going to go into, you know, putting shovels in the ground somewhere, or, you know, helping to, in theory, and helping to build out this data center thing, or, right. Is there something else?
So it's not necessarily consumer-facing AI products that we're expecting out of this. This is actually going to be money that's going toward building out those data centers, and also just thinking about servers and chips and all those ambitions that this company has. So that's what you're really seeing being placed on this situation right here. But investors are still concerned, and that's really what you're seeing here in the share reaction. Take a look at, we did see the peak back in September for Oracle. Stock is down about 50% since then. But if you take a look at Wall Street, people are still pretty positive on this stock. I'm looking at the A&R page. We see about 74% of Wall Street analysts have a buy rating on this stock. Only one sell. That's Rothschilds and Redburn.
Oh, wow.
Yeah, it's really interesting, too, that the company says that it doesn't plan to sell any more debt in 2026. We'll see if they can stick to that. But it really speaks to their overall ambition to keep that investment grade rating. We know that that is very important to company management.
Absolutely. So that's really important, especially as we think about how the broader perception is for the company as well. Keeping that IG rating is super important and integral to this company. So you're seeing them being really thoughtful about their approach here, but still you are seeing investors really concerned about what this could potentially mean as to whether or not they're actually going to see the return on their investment in the same way that the company expects.
I mean, this gets to the idea, too. I mean, Oracle's not the only one that's been under pressure. There's been a lot of concerns about how a lot of these companies in the AI space are going back to the debt that market. Healthy companies, but still, when you start to add on that much to your balance sheet, the question is, again, you have to sort of adjust your financial models for how you value these companies. And that seems to be a big part of the reason why not only is Oracle down, but I mean, when was the last time most of these stocks even hit record highs, whether you're talking about the hyperscalers, even the chip makers? I mean, you have to go back to the fall of last year.
Absolutely. I mean, you are seeing a lot of people really concerned as to whether or not these companies are taking on too much debt. So that's what you're really seeing to be the focal point here for Oracle in particular, as to whether or not they are actually, what the leverage is really looking like more broadly as we think about this company. But we'll have to see how everything necessarily trickles out moving forward. But that certainly is the concern that continues to be underscored by the market.
Someone really wants to get in contact with you.
You know you can mute that, right?
Yes, I wish it was muted before.
It's crazy. Sometimes I get here and someone has turned the volume way up.
Right, it's on the max.
Ghosts in the machine. Norah, Mulinda, great reporting as always. That is our Bloomberg TV markets correspondent. And it is really interesting, even with the S&P 500 hitting record high after record high, as you point out, Romaine, that a lot of these names haven't seen fresh all-time highs since last fall. Yeah, some would say maybe that's a sign of a healthy market, the idea that you're seeing a healthy rotation. But again, the idea when you have the companies with those types of weightings, I think the big concern is what happens if they miss on some of those projections. We're going to talk about that all with Sherry Paul. She is private wealth advisor over at Morgan Stanley Private Wealth Management. She'll join us now next to get to those closing bells. This is The Close on Bloomberg.
One of the big concerns for central banks around the world, you've seen it with the Bank of Japan, is when the central bank is holding a ton of government securities. Right now, I think for the Fed, it's about $4.5 trillion. It does lead to the question, at what point does the central bank look like it's funding the government?
Raghuram Rajan over at the Chicago Booth School of Business, talking about the potential impact of shifts in Fed policy under new leadership, potentially, we should say, with, of course, Trump pushing Kevin Warsh to succeed Jay Powell. Absolutely. That's going to be probably the story, or at least one of them, of 2026. But you take a look at the micro right now when it comes to the S&P 500. It looks like we're going to finish the day at all-time highs for the big benchmark. You can see that big tech is rallying as well. We have Palantir earnings after the bell. They were one of those I'm really interested
names
in this
that you
one.
mentioned.
Because we were just talking about Oracle and that big drop. But remember, all the big leaders that we had last year, a lot of them haven't hit record highs since the fall of last year, partly because of high valuations. And Palantir, I think, is what probably the highest multiple in the S&P right now. So a lot to prove there, and more or less our investors are going to buy into the story. I love this stat that even with the sell-off, they still trade those shares for 142 times expected earnings. Okay. So there you have it. All right, I have no comment for that. We're going to find out in a few minutes there. But before we get there, let's bring Sherry Paul into the conversation. Private wealth advisor at Morgan Stanley Private Wealth Management, here to help us count you down to the closing bells. And I'll actually start there, too, because I do kind of want to know, like, what you're telling clients, where you're telling clients to put money, particularly in light of these phenomenal gains that we saw in some of those big technology companies last year. And I know they've come down in value to a certain extent. Is that sort of a sign that it's over, or is that a buying opportunity, maybe an entry point for folks?
Yeah, it's a great question.
Yeah.
You know, look, we're centering client portfolios on what I'm calling the magnificent thematics away from the Mag 7. And one of those enduring thematics is the continued build out of automation, AI, industrial revolution. We've been talking about this now for, I want to say, almost 3 years.
Yeah.
So for clients that we're early buyers of this. We're rotating, rebalancing, taking gains and right-sizing those positions. And moving into this now second sort of thematic as I look out, I'm looking out over the next 2 years. And what's really coming to my mind is that we have to recognize now that every company is now a tech company. And those that realize it are going to survive and thrive. And those that are behind are going to face some sort of corporate extinction event. And I think that could happen more rapidly than it did in the early days, you know, of the launch of the internet. And so we're staying in big caps, big balance sheets that can pay for change, the pace of change that they can absorb. And then we're going to start to see these big cap companies just continue to get bigger. But the installation trade across the healthcare sector, across financials, and then the manufacturing convergence of this is super important too.
I am curious about the manufacturing convergence of this for a couple of reasons. In the short term, we've got some relatively decent economic data, and that's giving a boost to a lot of industrial stocks, a lot of economically sensitive stocks. But longer term, there have been a lot of people talking about, okay, if you want to play the data center trade, obviously it could be energy, but it's also, the folks who pave the roads that lead up to these data centers, or the folks who have to install, other types of infrastructure for those communities here. Are you finding opportunity there yet, or do you wait?
Yeah, I'm encouraging investors away from playing the trade and invest in the trend. And those are like enduring multi-year themes. I mean, it was 3 years ago I talked about for clients to pay what I was calling the innovation premium. And now I think going forward, we want to recognize to have them pay the installation cost reduction, productivity enhancing premium across other segments of the market.
That's not as pithy as the last phrase, though.
No, it's not. But it's almost. It's getting close. Yeah, but I'm really looking out at this, and this is a multi-year sort of cycle. So not such a big fan of the trade as much as the trend. Now you mentioned the build out of data centers. What we're witnessing, I think, is a distortion and a mutation of the S&P 500 as these large tech companies, in effect, become and operate and look a lot like holding companies. And so the sector weightings within the S&P get a little bit distorted when you've got companies sitting in the same category as retail that are launching rockets, and media, and companies that sit in the tech space that are also have movie businesses. And so I think that needs to be very acknowledged at this moment as being forever changed.
I do think that's a fascinating point, that especially when it comes to some of the tech companies, they look like conglomerates, or like you're saying, holding companies at this point. But I want to talk to you about something that might be a trade, because there's a really interesting note out from Barclays global head of equities tactical strategies. And this is about the fact that, potentially we're going to get Kevin Warsh as the new Fed chair in mid-May. So they note that actually since 1930, the S&P 500 has seen average drawdowns of 5%, 12%, and 16% over 1, 3, and 6 months periods after a new Fed chair took the helm. I mean, since 1930, that's a pretty strong stat. But I mean, what do you make of that? I mean, is there anything useful to glean about that?
Well, I'm going to match you with another fun fact, which is, and I say this to clients, the one thing I can guarantee them every year, 100%, is an intra-year decline, because it happens every year. So that becomes a step-in moment, right? Which is why time in the money, time value of money becomes so crucial when trends are so emergent. This is why I'm saying invest in the trend over a time horizon. But to clarify, I'm glad you brought it back to trade. Tactical allocation is a form of rebalancing. Okay, that's not a win-lose, that's an adjustment. So we should be looking at portfolios both from tactical rebalancing, which I would say 3 to 6 month time horizons, beyond that more strategic allocation that in my case is very goals-based and matched to that beating heart, that human that's actually living in their money, which distinguishes the portfolio management style that I have versus technically institutions.
So we have about a minute left, but I mean, with that in mind, how would you potentially play the next 3 to 6 months? Would you accumulate dry powder to maybe take advantage of what history suggests is going to be a drawdown?
Well, yeah, I think they're all yes, and yes. History suggests there'll be a drawdown. The size of the drawdown typically gets dictated by what the policy or the political football may be beyond or leading into recession, and the market sniffs it out ahead of time. Very hard to see the market sniffing out. So this would be about structural change at the policy level, which typically puts us into single digits, low double-digit type resets. What we've rotated out of recently would really be in the software space, so sort of recognizing where the flow of capital is. And really, we're in this moment where I'm also explaining to clients that AI is the new arms race. This enormous convergence of CapEx spending at the government level and at the corporate level, meeting the moment, I think actually transcends whoever, frankly, is in the Federal Reserve.
All right, Sherry, always a great conversation. Sherry Paul is Private Wealth Advisor over at Morgan Stanley Private Wealth Management, helping us count you down to the closing bells. We're just about 2 minutes away from that here on a potentially record-setting day for the S&P 500. And get this, for the Dow transports, if you will. A full breakdown starts with our global simulcast, and it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. It starts right now. Carol Massar, Tim Stenovic in the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on a potentially record-setting day for the Dow Transportation Average, as well as the S&P 500, and a happy belated birthday to Tim Stenovic.
Oh, thank you. Yeah.
It's huge, right?
That record's for you, Tim.
You sort of hid that. It was on Friday.
You did.
You did not mention it to anybody. Are you ashamed of turning 50? What's wrong?
You know,
No, it's just not a big deal anymore when you're a grown-up, you know?
Yeah.
No, I
You're
don't
50?
know.
Except if you're Katie.
I love birthdays.
You make sure that when her birthday rolls around.
No one will ever forget.
Exactly.
I always take that week off, but still, you'll know.
It's a week-long affair,
It's May 18th, by the way.
All right,
Anyway.
should we talk markets?
Yeah, why not?
Let's talk markets.
all right, there's a look at the Dow Jones Industrial Average. We're just pretty much hovering near our best levels of the session here, kind of an even split in the S&P 500. But as you mentioned, we could see some records here.
I will say Katie's husband texted me before Katie did.
Wow.
About my birthday.
Well,
About your birthday?
About my birthday, which was nice of him, even though I work with Katie every day.
Well,
How did he know?
I was sitting next to him, and I actually have Tim's birthday in my calendar because I've forgotten for a few years, and it didn't remind me. But I said to Joe, "Oh my God, it was Tim's birthday!" So he got on the horn.
Thanks, Joe.
Anyway.
All right, on that note, let's get back to the markets here on what is going to be, it looks like, a record-setting day, at least for the S&P 500. Right now, you're looking at an S&P up almost 40 points on the day, or about a half a percentage point. And I do just want to point out, it takes a while for these numbers to settle, and we might actually come up just a little bit short of that record high. Nevertheless, 69.76 and change. We'll get back to those numbers and let you know if that is a record high. The Dow Jones Industrial Average up more than 500 points, or about 1% on the day. The NASDAQ up about a half a percentage point on the day, and the Russell 2000 adding about 1% here on the day.
All right, as we await the market settling in, just a quick check. We have a little bit more of a bullish tone, if you will. 291 names, Katie, in the S&P 500 higher today, 212 to the downside.
And we are awaiting some earnings here, but let's talk about the sector here. You can see that the energy sector was the biggest loser today, down about 2%. Consumer staples was your big winner, up by 1.6%. You would typically look at that and say maybe that looks a little bit defensive. Not today, though, on a day where you had pretty broad breadth with 8 sectors in the green overall.
And I just want to go back to that, the S&P falling short of that record high by just about 1.5 points, Carol.
All right, good to know. I'm going to go to some of the outperformers. SanDisk certainly on that list. I believe it's the top gainer in the S&P 500 today. I mean, this one just continues to be on a tear, and you can see in today's session, this one up another 15% in today's session. Company is up about more than 180% year to date. That's and it's up about 1,700% since it was spun off last February. It was spun off, of course, from Western Digital. What's interesting is you continue to see analysts coming out, and they have been upping their price targets on the company since it reported earnings on January 29th. 15 analysts have raised price targets by an average of 86%. No analysts have cut price targets on the company. And we did see the 12-month price target is about 675.58 versus about 481 pre-earnings. So just a little bit of context there. Let's go to Western Digital, also an outperformer in today's session. I think this may have been the number 2 gainer in the S&P 500, number 3, forgive me. And that one is up about almost 8% in today's session. This is another one, different in terms of the product offering for SanDisk, but they both have an AI story connected to them. And this one's up about 60% year to date, and up about almost 300% in 2025. But again, it has to do with analysts raising their price targets. You've got some
kind of weird that we talk about the S&P 500 for the top 10 stocks, memory stocks, 2 of them actually in the cruise ship space and a couple in the trucking space. Meanwhile, let's get back to, well, whoever else. Elon Musk now confirming that SpaceX, his company, is going to merge with his AI company, xAI. A company memo that Bloomberg has obtained confirms the reporting from last week that Elon Musk's SpaceX will merge with XAI. We'll try to get you some more details on that. And, of course, the potential for what everyone assumes is going to be an IPO at some point this year. Carol?
No, but you know what we wanted to say is just to add on that, we talked to Ross Gerber over at Gerber Kawasaki, who has obviously owned Tesla, XAI, and other companies. And he was actually out with a social post today that basically saying, you know, when one of these entities needs money, they kind of turn to Tesla. And I think, you know, he has maybe some questions about, like, he thinks he's an innovator and so on and so forth, but just finds it's interesting that this is what this company continues to do.
Yeah, I guess how consolidated does Elon Musk's empire get ahead of the SpaceX IPO? That's the question I have.
Yeah, I mean, it is fascinating. You think about why this combination might make sense. What's coming from the companies is that you think about SpaceX's ambitions to build data centers in space. XAI plays into that, but it'll be interesting to see, you know, how this wraps all together with that potentially June IPO that SpaceX is reportedly targeting.
Yeah, it seems like a lot of moving pieces, like together, apart, and so on. All right. Hey, listen, I'm going to go back to just one other gainers. It's not a household name. Peakstone Realty, ticker is PKST. This one up 33%, so pretty much finishing at its highs of the session. Shares surging after the Canadian private equity firm Brookfield Asset Management said it will buy the industrial REIT for $21 per share. It's an all-cash transaction valued at about $1.2 billion, so that represented a 34% premium to Peakstone's closing price on January 30th. So kind of moving up, representing that premium. So that was definitely an outperformer.
Okay, well, as we await earnings from Palantir, let's get back to Elon Musk's empire, and that would include Tesla being one of the main decliners in the S&P 500 today. European sales, that slump carried into this year. Registrations of new vehicles plummeted in two of the region's leading markets for battery EVs. Tesla French sales fell 42% in January. Just 661 cars were sold. Norway registrations plunged 88% in January. This is nothing new as people have pushed back against Elon Musk around the world. Romain, Palantir. Palantir,
the data analysis software company, out with its earnings right now. In the most recent quarter, revenue does look like a beat, $1.41 billion. The street, on average, was looking for 1.33. EPS in the quarter, 25 cents. The street was looking for 23 cents. And EBITDA, also a beat there as well. Going to take a little bit longer to dive into the forecast. And here is that forecast now, crossing the wire. The company says that for the full year, revenue will be in a range of $7.18 billion to $7.2 billion, a tight range that's well above street estimates. The average was 6.27, shares higher by about 3 to 4%.
Yeah, it's interesting to see the after-hours reaction right now, bouncing around, but solidly higher. As we were talking about before this simulcast, remember, Palantir was down about 29% from its November peak. So this was a company that needed some good news. It looks like it's going to get that. I will point out, though, Tim, that even with that sell-off that I just mentioned, I mean, shares were still trading for about 142 times expected earnings. So this is a very pricey stock.
Yeah, I think that's a fair assessment. I'm down 30% roughly from those November highs post-earnings last time. Palantir shares higher by as much as more than 5%. 2026 revenue forecast did top estimates. First quarter revenue, $1.53 billion to $1.54 billion. That beat estimates of $1.34 billion. Fourth quarter adjusted earnings per share beat. Fourth quarter revenue beat. Fourth quarter adjusted EBITDA also beat. Shares up more than 5%.
Yeah, and maybe, go ahead, Romain.
Well, I was going to say, too, I mean, I know everyone talks about that valuation. You're still talking about a company, at least based on traditional financial metrics, is growing at a clip of about 70% year over year. But I'm going through this press release, and particularly some of the commentary by Alex Karp.
Yeah,
as you can imagine, it's bonkers.
It is. I didn't know what it meant.
And we talk about this idea. They are actually going by their Rule of 40 score, and they're basically saying that based on that, their growth is 127%. We are, quote, an N of one, and these numbers prove it. Palantir is alone in choosing to exclusively focus on scaling the operational leverage made possible by the rapid advancements of AI models that we call commodity cognition.
Huh.
What does that mean, Romain?
I have no idea.
Yeah.
In some ways, he kind of reminds me of Elon Musk in terms of this big personality CEO who's willing to go and make very bold statements.
Well, I think what's kind of interesting, too, I'm just going to go to the revenue line. We did say it grew 93% year over year, 22% quarter over quarter. Commercial revenue grew 137% year over year. But I want to go to government revenue, which is such a big portion, I think more than half of their revenue, growing 66% year over year, 17% quarter over quarter. One of the things that investors have been concerned about is that they want them to broaden out and broaden away from kind of their government exposure. So we'll see what kind of commentary and color we get on that on the call. All right, maybe we'll get an explanation of that statement, because that's a little
Anyway, decent growth, 34% year over year in terms of customer count. Commercial business also improving as well, up about 145%. See you guys.
All right, see ya. Stock is still up about 5-6% in the aftermarket. All right, guys, that's a wrap. Remain and Katie continuing on TV, and of course we continue right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And we want to go back to some breaking news just a little while ago. Bloomberg reporting, based on people familiar with the situation, that Elon Musk does plan to merge his SpaceX business with his AI company, xAI. Joining us right now to talk a little bit more about this is Ryan Gould. Ryan, all right, what's the plan here? We talk about SpaceX, which you know is pretty much a phenomenal business. xAI, maybe not so much. What's the reason for this combination?
I think, to put it bluntly, he wants to put data centers in space. Elon's view is that we're going to have data centers in space, and part of this is about, putting compute and the idea of space exploration and sort of exploration of the universe together. This is clearly part of his vision. There is a very good quote that kind of encapsulates a lot of this, which is what he wrote, I think, late last year, which is that in some ways his three companies, Tesla, SpaceX, and xAI, are going to come together. They're going to converge. And maybe this is kind of the first leg of the stool that we're now seeing. The convergence of the Musk universe, we're watching it in real time. So this is a merger. Do we have any idea of terms or what kind of numbers are involved? We've been chasing this all day. I would imagine. Yeah, he's apparently just sent out, so our sources say, a memo to SpaceX and xAI staff explaining or confirming the merger, which we reported this morning. It looks as though things are kind of a little light on detail right now, but I'm very interested to see what valuation this company has. We're talking about two of the largest private companies in the world. This is all in light of SpaceX potentially looking at an IPO that could come, we thought, as soon as this summer. But given that you're now looking at a very significant merger of two private companies, you'd have to imagine that plan would be potentially pushed back. I will say, and I tweeted this last week, in a way it's kind of beautiful that you have SpaceX, again, in a sense, merging with Twitter, which is now X, which is now a part of xAI, which really speaks again to this sort of convergence that we're seeing. And now Twitter, in a sense, could be going public again. Yeah, it's true. And when you think about that whole escapade around the take private of Twitter, don't forget there was the whole issue around the debt, some of the banks being stuck with the debt that underwrote that Twitter acquisition. That's the very same debt that's still within xAI. So if I'm a bank or a lawyer right now, I'm surely looking at those numbers thinking, how are we going to make SpaceX essentially, take on some of this risk that's underlying in that debt? All right, Ryan Gould, looking at the potential combination here of SpaceX and xAI. Of course, are two of the most talked about, and at least with SpaceX, one of the most valuable private companies out there. And of course, what comes next right now? Another redhead actually crossing the Bloomberg terminal right now, saying that SpaceX and xAI together would be valued at $1.25 trillion. Again, this is coming from the company memo that Bloomberg reporters have seen, although we should point out this information is not yet public. Let's bring Ed Ludlow into the conversation. And Ed, I do want to start off with that $1.25 trillion valuation. And I guess my question to you is, how much of that valuation is SpaceX and how much of that is xAI?
The vast majority, and just to clarify something you guys were discussing a minute ago, there's two separate memos. The valuation comes from a memo that's been sent out by SpaceX's CFO, Brett Johnson. So, it's based on the terms of the combination, $1.25 trillion valuation, but a share price at $526. You can do the math on the value add. SpaceX's last valuation was $800 billion in the tender we reported. And xAI is just north of $200 billion. But, Ryan did a good job on summarizing the kind of how we got to this point. There were a lot of SpaceX investors that were not in favor of this combination because of the debt component on xAI. So that debt's going to get factored into this, right? And they'll have to do some some interesting financial mechanics, just like they did when X, the social platform, and XAI combined into a single entity as well.
Yeah, and I'm wondering why it's important to these companies, to Elon Musk, to have this merger happen before SpaceX potentially goes public later this year. Because you think about SpaceX, obviously it has a viable product. It has a very impressive valuation. You think about potentially building data centers in space, that I could see that, but it just feels much further off and maybe not as relevant to this specific public offering.
Yeah, I mean, another point of clarification is that our understanding is that this IPO of the combined entity is going to go ahead. You know, when we reported that there were two scenarios under consideration, the merger of private SpaceX with public Tesla and the merger of the two private companies, XAI and SpaceX, a lot of people were asking quite rightly, well, what about this great big IPO that you guys have been reporting on? And our understanding from sources is that proceeds. Just to build a little bit on what Ryan was talking about, it's literally about inference, running AI models. And, you know, the point of having data centers, which are literally satellite form factor in space, you know, SpaceX builds them, has the capital to buy the GPUs, which it intends to raise from the IPO. And XAI makes use of that compute capacity because it is energy efficient and there is minimal latency in getting the results of running that model back down to Earth. That is the rationale. But you have two very different companies now combining that were in different financial health.
Right.
You know, SpaceX has rude revenues, but also seem to be quite profitable. XAI burns through cash like it's going out of fashion.
All right, Ed, just fascinating stuff. Really appreciate your reporting here. That is Bloomberg Tech co-host Ed Ludlow. We will continue to follow that story. But let's turn back now to Palantir's, those results dropping at the top of the hour. Let's discuss with Brent Thill. He is tech sector leader of software and internet research over at Jefferies. So let's talk about the outlook. Annual revenue seen between $7.18 billion and $7.2 billion. The estimate going in had been for $6.27 billion. So quite a beat there when it comes to the expectations. Brent, you can see that reflected in the shares. What do you make of what we learned at the top of the hour?
They're still crushing the numbers. And I think in a world of AI that is getting crushed in software, my coverage universe is going straight south. You know, Palantir's fundamentals are doing extremely well. Cash flow growth, well above forecasts. Their commercial business doing very well. Obviously, if you look at the government business, you can see what's going on in our world and the place they're going to be. So I think the fundamentals are screening high. You obviously have to pay a price, which is it's the single most expensive stock by a factor of 2. So, you know, if we were in a better tape, stock would be up a lot more. You know, we're dealing with a stock that's still 45 times revenue, and it's still one of the most expensive names. And we've had a whole group that's under massive duress because of what is AI going to do. So they're fundamentally in a great spot. Obviously, valuation is why the stock is sold off from over $200 to mid 150s,
right,
is because everyone's checking the valuation and realizing it doesn't really make a lot of sense.
Well, valuation being one thing, let's talk a little bit more about fundamentals, because we know that Palantir makes the lion's share of its revenue from its government contracts. We know that there has been a push to maybe diversify that out to commercial contracts as well. What are you seeing there in terms of progress?
Yeah, I mean, the commercial business, they're guiding growth of over 115%. So, I mean, there are not too many companies putting up those numbers, right? We talk about a 10 to 15% growth rate for a lot of the large cap names, and they're pushing 115. So, you know, it's not even really comparable. And I think this goes back to every boardroom globally is thinking about AI. They're thinking about how do I implement this, whether I'm healthcare or I'm a retail company, whatever your business you're in, you're thinking about this first and foremost in the boardroom. And they've done a great job. You have companies, commercial companies now highlighting them on earnings calls, saying that the product is taking costs out of the supply chain. They're putting people into hospitals faster and getting the right healthcare. So, I mean, they're solving problems, as they say, that no one else can solve. And I think they really solved the puzzle, which was the Tesla problem at the beginning. You know, the car can only shuttle around doctors, lawyers, and people that have 30 years of experience because they're so expensive. And what they figured out is how to bring the software more to the mass market, to more commercial companies, and they have done a really good job of solving this. And so putting up 115% growth is pretty incredible. And I think it shows they've overcome the problem, which was, where for a very few select people, they're now showing with these numbers that they can address a bigger portion of the commercial market, which is exceptional. And I'd say that the companies that we talk to in our industry that love data are all acknowledging how well Palantir is doing. And so if you talk to Oracle, you talk to many others, even Mark Benioff is talking about, the model of forward deployed engineers. That tells you a lot about, the fundamentals and how they run and the success they're having. And so I think that's when others in the industry are trying to emulate you, you're doing something right. When you put up 115% commercial growth, you're doing something right.
Yeah, no doubt about it. I am curious, though, Brent, if you think this is a company that can actually grow into that valuation a little bit. I mean, we know on the government side, obviously, the ties to the current administration have helped a lot. It's good and encouraging to see them expanding a little bit more on the commercial side. But again, I mean, I know for a lot of investors, fundamentals don't seem to matter anymore. But when I look at these multiples, I just think, when did they grow into that?
Yeah, I mean, that's the pushback. I mean, again, I think we try to rate it in two different parts of our rating. It's a buy fundamentally. It's a strong sell if you had a strong sell on the multiple, because if you look at the next tier down, you have companies like CrowdStrike and some really good companies that are trading, sub 20 times revenue, and this is still 45 times revenue. And so, at $200 plus, we were just like, this doesn't make any sense on a valuation basis. Right. And so, you kind of have to basically say, what's the available TAM? Can they grow into that? Can they sustain these rates? Can they sustain the cash flow? And what they're proving is they can do a lot of these things. It's just that's going to take forever for the multiple to come in. And so we saw this with Snowflake. We saw this with many other names we cover. It can just take a long time to grow in. So what we've said is, like, you can buy Meta at mid 20 times earnings, but you got to pay 50 times revenue for Palantir, and I'd much rather buy Meta. And Meta's stock's up and Palantir stock is down for the year. So I think our trade-off is, like, everything has a price, and we look at both fundamentals and valuation. The valuation has just been impossible for many of the long onlys that we cover on the institutional community to stomach. And the good news is we're seeing the software sell-off. We're seeing the multiple. We've seen the stock trade off from over $200 to mid 150s, and it probably finds some support. But the problem that they have going now is the multiple is just, again, we're in a multiple free fall in my entire coverage universe. And so the question is, are they in the AI winner or loser? I think many believe they're in the AI winner. They get a multiple and premium. The question is, what's the premium going to be? Great company. Again, I just can't say, nice enough things about the fundamentals. It's just the valuation also matters.
Yeah, absolutely. All right, Brent, always great, insightful analysis. Brent Thill, tech sector leader of software and internet research at Jefferies. Palantir shares up about 8% in the after hours trade, a stock that earlier today closed with a price to earnings multiple of more than 200 times current earnings.
All right, so digesting those earnings, we're also bracing for an earnings tidal wave from some of the world's largest pharma companies this week. Pfizer and Merck kick things off tomorrow. Then we have Eli Lilly, AbbVie, and Novo Nordisk all reporting on Wednesday. You also have Bristol Myers on Thursday. Let's discuss with Asadd Haider. He is head of the healthcare business unit within Goldman Sachs Research. Great to have you with us. I want to start with Pfizer because it's interesting. I mean, you think about Pfizer, they've been stuck in a little bit of a rut. You think about that post-COVID vaccine era, certainly taking a chunk out of shares. They have a whole bunch of patent expirations coming up. They're trying to enter new markets. Are you expecting them to be able to sort of shape and reset the narrative, or at least further that reset tomorrow?
Yeah, thanks for having me. It's a great question, and it's a central question. And with Pfizer, it's a little bit different to some of the other companies that are actually reporting earnings this week, for the simple reason that they've already issued 2026 guidance and given you some direction on where 2025 will land, right? So it's not about numbers as much as it is about the forward narrative. And starting this year, they are actually entering the first of 3 consecutive years of patent cliff-related revenue headwinds, and those are going to compound each year. So this is the smallest one numerically, and then the headwind gets bigger in 2027, and then again bigger in 2028. And so that's recognized and understood, and that's modeled in consensus numbers, including our own, in terms of top line erosion. But I think the story from here really has to. It really rests on whether or not they can start to unlock opportunities across some of the other pipeline opportunities that they have built through acquisitions and even through their own internal portfolio. And front and foremost for that is really how they discuss and describe the opportunity in obesity. And so I think tomorrow morning, there's going to be a lot of focus on how they talk about expectations for where they are with the Metsera acquisition they did in terms of the trial readouts, including the monthly version, which is expected to read out at some point in the first half of the year, if not sooner, but also the obesity assets they've got behind those, and then some of the oncology portfolio that they've got as well, where they've got some catalysts in the first quarter that they've been talking about. So it's much more about getting clinical wins on that catalyst path than it is about numbers, and those are absolutely necessary for how people think about both the multiple but also the journey into and out of these compounding headwinds.
Well, let's talk a little bit more about the obesity opportunity. You mentioned Metsera. That was a hard-fought bidding war that they ultimately won here. But you think about the obesity market, it's pretty well established at this point. You have Novo, you have Eli Lilly. I mean, are you confident that Pfizer will actually be able to carve out a niche there?
So, this is really a pivotal year for the obesity market from the standpoint of the oral launches. And so you've had Novo Nordisk's pill on the market now for, call it, about just under 4 weeks. And the way that I think psychology or investor psychology around the obesity market is going to evolve specifically this year is going to be very anchored and tethered to how the oral launches go. So you've had Novo, like I said, and that's going to be followed very shortly by orforglipron from Eli Lilly, which we expect is going to launch at some point in the second quarter and bring with it a volume unlock, including in some of the government channels that came as part of the MFN deal that these companies did with the Trump administration. But that doesn't mean that some of the clinical readouts in next generation obesity pipeline compounds in the pipelines are going to get. They are also going to be, they're going to get attention. And I think Pfizer's monthly version is definitely something that if they are able to produce efficacy that looks like the weeklies and good tolerability that holds up at a monthly level, then I think there's probably a place for that in the market. And I think there's going to be a lot of interest in how they frame that opportunity. And just to put some numbers around it, we actually have already put about $4 billion unrisk adjusted in our Pfizer model for the obesity assets that they have post the Metsera acquisition. So the question really is how comfortable both ourselves as well as investors and other sell-side analysts feel about the direction off of those consensus numbers about that opportunity. But we do, yes, see a place for the monthlies, including Pfizer's portfolio, and we model that into the way we model our anti-obesity market.
Hey, before we let you go, Asadd, I do want to get your thoughts on, I guess, a slightly less sexy healthcare company, and that's being Bristol Myers. And I am just curious as to sort of what is the growth story there?
Well, there is an obvious near-term growth story, Romain, and that's why the stock is trading at pharma's lowest multiple relative to the peer group, about, call it, just under 9 times versus the group closer to 14, 15 times. So a huge discount. And I don't think it's about near-term numbers. It's really about, again, similar to Pfizer in some ways, clinical trial successes. This company came off a series of pipeline setbacks in 2025, clinical trial setbacks. And so the story from here in 2026 is really going to be about pipeline wins that are absolutely necessary for the stock to see a sustained re-rate in our view. And the anticipation of those pipeline wins has actually been juicing the multiple a little bit to some extent. It's seen a nice bounce off of the lows, but a lot of these are still binary, very high risk, and clustered towards the fourth quarter in our view. And so that makes it a little bit challenging.
All right, Asadd, got to leave it there. Great stuff. Asadd Haider, head of healthcare business unit within the Goldman Sachs Research, here on The Close. When we come back from the break, we're going to take a focus on the business of sports with the Super Bowl just a few days away. We're going to talk to Rashaun Williams, the founder over at Harbinger Sports Partners and a minority owner in the Atlanta Falcons. Stick with us. This is The Close on Bloomberg. All right, well, this Sunday is Super Bowl Sunday, Super Bowl LX, or 60 as normal people call it. And if you're in the market to buy an NFL team, well, you're in luck. After the face-off this Sunday against the New England Patriots, the Seattle Seahawks will be put up for sale. It could potentially be one of the biggest NFL deals of all time. Joining us right now is Rashaun Williams, founder over at Harbinger Sports Partners and a limited partner in the Atlanta Falcons football team. Kind of an interesting matchup here, not necessarily on the field, Rashaun, but really kind of, I guess, in the bank accounts, if you will. We know the Patriots are already one of the most valuable teams in the NFL. And I know the Seahawks are somewhere like 14th, 15th ranked, but everyone's saying that if they actually strike a deal, this is actually probably going to be the biggest the NFL has seen. And it's kind of interesting that it's coming right after the Super Bowl potentially. So does a win potentially help the valuation there?
Well, whether they win or not, this is still going to be the biggest deal. And whoever buys this team is clearly going to be a winner. And whoever sold it, the estate, is clearly going to be a winner as well. I mean, you never really see two major things happening like this at the same time. But I was just listening to you. I'm getting fired up about it. I wish I had an extra $7 billion to buy it myself. So I'm excited about it, man.
Well, that's what I'm curious about, too. I mean, typically in the old days when, a team like this went on sale for a high value, there were usually a very small group of people who can afford it. Obviously, with the NFL loosening some of the ownership rules to allow private investors to come in and take smaller shares here, I assume that's probably going to lift this valuation probably more so than if just one single collective had to buy it.
Not really, because the rules stipulate that private equity firms can't be majority owners.
Oh, okay.
So I don't care how many private equity firms are in the mix. They can't buy the majority stake of this team. It has to be a family-owned business, and it's going to be an individual who maybe has a consortium of individuals behind him and private equity, but that individual is really going to strike the price, be the lead investor, and take this thing across the finish line. So it's not private equity driving this price increase. It's really the core fundamentals of these teams and of this league. And I'm talking about the biggest viewership of all time, the biggest sport, and the biggest game of the year. I mean, it's just perfect timing for them to put it on the market.
Yeah, absolutely. What a showcase, the Super Bowl right before the sale. I do want to talk about what we're seeing in the NFL when it comes to valuations there, when it compares to other sports, for example, which we know draw a lot of eyeballs. You think about basketball, for example, you think about Major League Baseball. Contrast and compare what you're seeing there.
Yeah, well, I can't speak in too much detail about the NFL because of my ownership in the Atlanta Falcons, but I can tell you it's actually very simple. And I want to draw a comparison to an industry that you guys know pretty well, software. So the reason why software companies trade at an average of 10 times revenue multiple is because of the annual reoccurring revenue stream that's growing at a pretty high CAGR against long-term contracts and has a moat around the business. Well, there's another industry that has a very similar revenue profile as software companies that trades around the same multiple as software companies, and it's professional sports teams. Sometimes 2/3 to 80% of the revenue stream is from big media and big sponsorships. So when you have that already baked out for 10 to 15 years, and that revenue stream is growing and they're diversifying into real estate, that makes this asset class very attractive to not just retail, high net worth individuals, but to institutional investors who are over-indexing in sports today and asking for more and more of it. But it's really about the moat they have around the business, the annual recurring revenue stream, and the product that they're putting out on the field or the court. It's just spectacular.
Well, forgive me if this is a dumb question, but you touch on something that I always wonder about when it comes to investing in sports, because I can get my mind around a software stock. I can think about the dividends that they throw off, buybacks, et cetera, and the stock itself going up. When it comes to, investing in a sports team, you mentioned, recurring revenue. What form does that take, and what are you receiving piecemeal versus, just being eventually able to sell this stake?
Well, thanks to the Atlanta Braves, which are a publicly traded company, you can actually go right through the P&L on the balance sheet of a professional sports team that is absolutely crushing it and see exactly what they're doing. So, for example, the Atlanta Braves went from $250 million in revenue to $650 million in revenue by transitioning their business model from just getting money from the league, media revenue and sponsorship revenue to also diversifying into real estate. So they own the stadium, they own the parking lots, they own the commercial and residential real estate, and they grew their revenue 250%.
Yeah.
So when you buy into a team, you're buying into a holding company that is becoming a media company that has a live event component of it, but they also have a real estate component of it. How many different ways can you monetize this IP that you have? And how can you monetize it 365 days a year instead of 10 days a year if you're NFL team or 100 and something days a year if you're a baseball team?
So, Rashaun, I mean, the excitement that you have and obviously just the growth that we've seen in sports, I mean, it raises a big question just about investor access to this. And by that, I don't mean like the gigantic folks who can afford to spend billions of dollars on a team. It's one of the reasons why you have Harbinger Sports. I saw just, was it last week or so, you announced this deal with iCapital to sort of get into that wealth channel here. Are you seeing more individual investors and more, for that matter, the investment advisors pushing stakes, small stakes, either in the teams themselves or through some of the products that you yourself have through your business?
Yeah, great question. Sports today is where tech was 10 years ago from a liquidity standpoint. So just like 10 years ago, no one was calling you to advertise a $200,000 position in SpaceX or Anthropic. No one was doing that 10 years ago. How many of your viewers have gotten phone calls and emails about Anthropic and SpaceX and OpenAI, you know, over the last 6 to 12 months? That market in tech secondaries is very liquid. In fact, 10 years ago, when I started doing late stage tech, there was no way to get into these things. Sports is going in the same direction. It starts out by opening the aperture to folks like private equity firms who then had thousands of investors underneath them who also want access. But you have to create the ecosystem that was already created, like in the tech marketplace, where you have these private marketplaces like Forge and Equities In and NASDAQ private markets and all of these brokers out here. And I think sports is well on its way, except sports has more price transparency. Everyone understands what the Yankees do for a living. Everyone knows the valuation of the Yankees, right? And there's already a built-in fan base. So I think the sports ecosystem for secondary liquidities will do better than even tech.
Yeah, you know, as a Chicago guy, Rashaun, it'd be nice if someone could explain to me what the Chicago White Sox are doing. But your point is well taken.
Rashaun, yeah, go on.
No, I was just he talked about the white, you know, I'm from the south side of Chicago, so that's near and dear to me. You just struck a chord with that one.
Well, then maybe that's a good place to leave it, Rashaun. Really great to get some time with you. Such an interesting conversation. That is Rashaun Williams. He is founder of Harbinger Sports Partners. Meanwhile, let's take a look at some notable movers in the after-hours trade, and we start with NXP Semiconductors. You can see shares taking a bit of a bath right now, even though their fourth quarter adjusted EPS beat estimates. A different story when it comes to AMD, higher by about 2%, and then Broadcom up there as well, rising a pedestrian 0.8%. This is the close on Bloomberg.
Will Sheth here, bringing fiber to the masses with Kellogg's Raisin Bran. Duty calls.
Will Sheth?
Every darn day.
Whoa.
Well, Kellogg's Raisin Bran is just one brand shelling out serious cash for a spot in this year's Super Bowl ad lineup. The top price for a 2026 ad hit $10 million for just 30 seconds of airtime. That is according to NBC, the network broadcasting the big game. Joining us live is one of the brains behind that Raisin Bran ad, which I'm still recovering from. His name is Gary Vaynerchuk. He is the chairman of Vaynerx, CEO of VaynerMedia, and co-founder of Vayner Sports. Gary, it's great to see you again.
Always good to see you too.
So this is something that we were talking about last week with the CEO of Row, which has a Super Bowl ad with Serena Williams. It's really interesting that even with all the talk about the demise of linear television, the Super Bowl obviously stands alone. So talk to us about the value of a Super Bowl ad and what that ROI still looks like.
You know, attention is what everyone's seeking. You know, you can't really tell someone about how great your product is if you don't have their attention. I on Madison Avenue for 15 years have been yelling that linear television commercials are overpriced versus the attention you actually get. But I've also always said, while I was the Pied Piper for social, that even social at its best, $10 million spent on Meta and TikTok perfectly, you can't get 100 million people to watch a 30-second video. Not to mention, look what's happening here. You get the collateral impact of running a Super Bowl. So the attention of a Super Bowl ad is disproportionately the best advertising media deal in the world, let alone America. The problem is if your creative isn't good.
Well, that's what I was going to ask you, because it's one thing to have attention. And I bring this up too. I was telling Katie this, I was kind of snowed in this weekend. I read this great book on branding. It's an older book by Naomi Klein. But it's the idea too of what are you trying to get across? You're not selling, to a certain extent, Raisin Bran. You're selling some sort of message, some sort of ethos out of it. So how do you do that?
By making it very clear that fiber needs to be a part of everyone's diet. And whether you're going macro, academically from a book, or you're in the trenches day to day like I am, and you're trying to get some sales in the short term at Walmart or Amazon.com and build a brand, it still has to hit. The attention is there. I'm on right now. If I say a bunch of nonsense, no one watching right now in this interview is gonna be like, oh, that's a guy worth looking into, or that's interesting. So the creative is still the variable of success. It's just that attention is so fragmented. We're all watching streaming and this and that. And so it's not 1989 anymore, and Super Bowl does sit on a pedestal. I would argue 10 million for the attention is cheap. But again, you can waste 30 million between production, talent fees, and all the other stuff that NBC makes you buy when you do Super Bowl. There's that part. So if there's a lot of people this Sunday who are gonna crush with Super Bowl, and there's gonna be even more people that are gonna waste a ton of money.
And we see this every year. And there's certain brands, obviously you have the big, gigantic brands, obviously like with a Raisin brand or something like that. But then you always have these kind of upstarts, companies that either have never advertised or relatively new. Who ends up getting the most value out of that? The company that has never really been heard from before?
No, it's a great question. Both. The company's never been heard for before, big shout out to Rome, big fan of his. They're gonna get awareness they never had before. Right? So a lot of people are about to discover them. And then for brands that we know, like Raisin Bran, it's a relevance thing. A lot of people just said, Raisin Bran. It's a reignition. So it's either relevance or it's broad awareness. New companies, the tech companies in the 2000s, the crypto companies, a new brand that's made some money, Poppy, big shout out to them. They get more awareness. More people now know that are just not seeing them in social feeds. But then there's brands that everyone knows, like a Raisin Bran, that are gonna work on relevance.
Like maybe you just haven't thought about Raisin Bran in a while, but now you're thinking about fiber. Gary, I wanna go back to a point you made that, $10 million for that attention. You could say that that's cheap, but you could waste a lot of money on actual production and putting it together. And that brings me to a question on AI. Because you scroll through social media, it's hard to avoid. You're gonna come across an AI image or an AI video. Are you expecting that we're going to have that experience watching Super Bowl ads as well?
At some point. Right now, the advertising industry is not being affected by AI as much as it could be, because everyone watching right now, the general public, is anti-AI because subconsciously they're worried about losing their job. So we're gonna have this 36-month window where the Gen Pop is gonna push against brands, and brands have dabbled. McDonald's dabbled, they got smacked. So brands are gonna pull back for 24 to 36 months, but the stigma's gonna go away eventually, and so eventually, of course, it's an inevitable outcome. Technology always wins.
But what does that AI ad look like? And particularly in the context of the Super Bowl.
Exactly
there's a reason why you have all these celebrities in there, right?
It's gonna look exactly
I pay attention because you had Will Shat in there. Or I pay attention to nerds because they have Andy Cohen or whoever else.
But I can pay Will Shat for his NIL, and William at 94 won't have to come on the set.
So you're saying like 100 years from now, we'll be seeing Will Shat in commercials?
We may if Will Shatner's family decides to arbitrage his NIL, or if he doesn't put that in his will. I fully expect my great-grandkids to make bank on my NIL in the future. I'll be doing this interview with you two in 120 years.
or our avatars or whatever. All right, Gary, always a pleasure.
Such a pleasure, thank you.
Great to have you here. Gary Vee, chairman over at Vaynerx and CEO of VaynerMedia. All right, we do want to stick in the world of sports, specifically MMA. We caught up with UFC CEO Dana White, and he talked about how he's looking to shake things up once again. Obviously, you're known primarily for MMA, but you've got you mentioned the Zuffa boxing venture that is getting up and running this month. Talk a little bit more about how far along that is and whether you think it will be a viable competitor to some of the other straight boxing promotions.
Well, I don't want to say we'll be a viable competitor. We're going to blow them all out of the water is what we're going to do.
And that was Dana White 3 weeks ago talking about one of his, well, maybe viable competitors. We had a chance to catch up with one of those viable competitors, Eddie Hearn. He's the chair of Matchroom Sports, and he responded to that and spoke with us about his newest challenger. Take a listen.
The UFC is a phenomenal business that has total control over its fighters. I mean, so unique that it can drive so much revenue and the fighter pay is so small. You know, some people call that unfair. I'm quite jealous as a business. I mean, it's a phenomenal business, and those guys are super smart. But, you know, the UFC fighters are paid a fraction of what fighters are paid who don't drive the same revenue as the UFC. So, but what they have done is built a brand that young fighters emerging are desperate to be a part of. So they sign that contract, they give the UFC their control, and, you know, boxing's completely different. Trainers, managers, agents are fully aware of what is in the pot. And that pot in America is remarkably protected by the Muhammad Ali Act, which is an act that is designed to protect the interests of fighters. And before every show that we do in America, we have to show the fighters the revenue that is in the show, which is phenomenal. And obviously now the UFC, TKO are trying to make changes to that Muhammad Ali Act.
He had his first big event, the Zuffa boxing last weekend. Did you get a chance to watch it?
I did, yeah. I mean, look, they're starting slow and they're starting small, and I think, but they're long-term players, you know, and they're a tremendous business. So I don't think they wanted to come out screaming and shouting. I mean, it was, you know, in the sort of filming facility with a couple of hundred people. It was very bland. No one had really heard of the fighters, but they're going to build from there. They're going to do well. They're going to be a success, and we're up for the challenge. I've always had a great relationship with Dana, but now we're competitors, and you know, some are billing it as Eddie v Dana or Dana v Eddie, whoever's the A side, and it's a pleasure to be duking out with those guys because they're a phenomenal business, and we think we're better. So it's great for boxing.
With regards to the television, the broadcast rights for a lot of these fights, do you see the pay-per-view model? Is that going to eventually just go away and it will be more dominated by the networks or the streaming services?
Yeah, I think pay-per-view is incredible, isn't it? Where, you know, boxing really and MMA previously before the Paramount deal are the only real sports where you have to pay extra, you know, for certain sporting events. I mean, you know, the big NBA games or the Super Bowl, you know, there's no pay-per-view system for those. So it's become quite recognised for fight fans to buy a pay-per-view for the big fights that they want. The Zone have a different kind of structure where it's a subscription fee. And I think the preference from everybody is to move away from pay-per-view, to be honest with you. And I think the problem with pay-per-view in America has always been the price point.
Yeah.
You know, and for me, $90 or $100 for a night of boxing sitting in your lounge, it's a lot of money. You know, in the UK, the price point is closer to $30. I think that's, you know, sometimes you can take that, but you know, the bigger price point. I know that, you know, DAZN want to move towards a subscription model where there's more value for fight fans. So I think that pay-per-view will always exist, and part of that reason is because of the, you know, the purses of the boxers. Like I said, you know, the guys fighting this weekend, Shakur Stevenson and Teofimo Lopez, they'll be making 10 times what Paddy Pimblett and Justin Gaethje made last weekend. Yet that show drove more revenue. How does that work? You know, and that's because fighters have been accustomed to the competitiveness of the world where everybody's willing. Boxing's a crazy business. There's always someone ready to go. It's like this, you know, it seems to be this sexy business where investors or people with money or broadcasters or sponsors, they go, we want to be in boxing. And it doesn't always work. But, you know, the competitiveness of the industry right now is hotter than ever, of course, with Saudi Arabia also coming in and making significant investment.
I do, before I let you go, I do have to ask you about Anthony Joshua. I think most people associate you with him in terms of your promotions. He just came off that big, I guess we'll call it exhibition fight. I don't know what we want to call it, against Paul. He was also involved in a tragic accident after that. And I'm curious if you've spoken to him. Is he planning to fight anytime soon?
Do you know he had a terrible car accident, lost two of his closest friends in that. Suffered some pretty bad injuries himself as well. And right now, we're just giving him the time to, get over it physically and emotionally, and mourn the loss of his close friends. He's a competitor and he's a strong individual, but you can't really imagine what he's going through, having been involved with that crash. But he's back training, not to fight, but just to keep himself mentally strong, and that's what he does, And I think he'll fight again, and certainly in the honour of Cena and Lats, but. It'll be a couple of months before he's ready to return to training camp. Perhaps in the summertime, he'll be ready to go. But right now, we just want to make sure he's okay, and that's the number one priority.
Boxing promoter Eddie Hearn there, the chairman of Matchroom Sport Group. As we take a closer look at the business of sports and we wrap up the close here on this Monday afternoon, we're going to push ahead to what financial markets will have their eyes on over the next 24 hours. When we come back, stick with us. This is Bloomberg. As we wrap up our coverage here on the close on this Monday, we push ahead to what the markets are going to have their eyes on Tuesday, and we start with some earnings before the bell.
Yeah, we have PepsiCo, PayPal, Merck, and Pfizer. As we were discussing, particularly excited for Pfizer as they try to basically reset the narrative when it comes to their company after 4 straight years of declines.
Yeah, I always like this time of the earnings season because you kind of feel with the financial companies and with big tech, it kind of distorts what's really going on in the economy. You get a much broader read from this much broader sense of companies, and then it continues after the bell with names like Chipotle, Mondelez, Take-Two, Amgen, and we still get big tech out of AMD.
Yeah, don't worry. Still AMD. We're still going to get that tech exposure. We also get some eco data as well. We get U.S. vehicle sales and JOLTS, though this may be delayed by the partial government shutdown that began on Saturday, if you forgot, which I did. That jobs report we were looking forward to so much, that's delayed already.
Yeah, we should point out the president speaking right now at the White House, urging the Republican Party to move forward on a deal that he struck with Democrats for a stopgap funding bill that would reopen the government. We're also going to get Fed speak tomorrow out of Barkin and Bowman. And something I'm keeping my eye on, Katie Greifeld, tomorrow, Ted Sarandos, the co-CEO over at Netflix, is going to be on Capitol Hill.
Yeah, absolutely. He's going to testify before the U.S. Senate's antitrust subcommittee on that proposed Warner Brothers deal. If you forgot about that, that is still very much percolating in the background.
Of course, we will have full coverage of any news that breaks out of that right here on The Close. Appreciate you joining us. Balance of Power is up next at the top of the hour, right here on Bloomberg.